In 2008, the global economy collapsed in a matter of months. Banks failed, companies disappeared, and millions lost their jobs. But this collapse didn't happen overnight. It was the result of a long chain of small, dangerous mistakes. So how did the world fall into one of the worst crises in history? It all began in the early 2000s. Interest rates were low. Banks were giving home loans to almost anyone, even people with low or unstable income. These risky loans were called subprime mortgages. People rushed to buy homes. Demand increased. Prices skyrocketed. Prices increased. Banks gave even more loans. This was a bubble. A bubble getting bigger and bigger. After giving out all those loans, banks did something unexpected. They bundled thousands of mortgages together, turned them into financial products, and sold them to investors as safe investments. These were called mortgage-backed securities. But there was a problem. The packages contained good loans mixed with bad loans, all in one box. Rating agencies still gave them AAA, the highest possible rating. Imagine selling a crate of apples, but hiding the rotten ones at the bottom. Housing prices couldn't rise forever. In 2006, the growth stopped. Then, prices began to fall. When prices dropped, subprime borrowers started defaulting. Monthly payments went up, people abandoned their mortgages, and banks were left with millions in toxic assets. Investors who bought mortgage packages panicked. Their safe investments had turned into worthless paper. The dominoes were falling. September 15th, 2008. One of the darkest days in financial history. Lehman Brothers, one of the world's largest investment banks, filed for bankruptcy. Its collapse sent a shockwave across global markets. Stock markets crashed. Banks stopped trusting each other. Credit froze. The global economy nearly stopped altogether. People and businesses suddenly had no access to money. The panic spread from the US to Europe, Asia, and the entire world. Banks stopped lending. Companies shrank. Millions lost jobs. The world entered the worst downturn since the Great Depression. This period became known as the Great Recession. The US government stepped in. Trillion-dollar bank bailouts, cutting interest rates to zero, huge economic stimulus packages. Slowly, confidence returned to markets. But the scars lasted for years. The lesson of 2008 is simple. Complex financial systems can collapse from a chain of small mistakes. And the foundation of every economy is human confidence.